What is going on, guys? Welcome to Stock Talk with Nico Criticos. Today, we're going to do some analysis to see is the stock market pointing to a crash coming soon, and what are the current signs? So, real quick, let's run through a couple things that ChatGPT suggests are things to look out for. As far as the 200-day moving average, I'm not concerned about that. That we will get into stock market valuations, but the big one is the oil shock risk, which, if we look at the oil price today, it's actually down over 11% because of the news coming from Trump that he's going to hold off for the strikes. But if you look at the last year, I mean, oil's normally around $60, and now it just hit over 100, right? So it definitely had a big spike. It's only been a couple of weeks though, right? It's only been a couple of weeks when it's traded this high. So it's not the end of the world yet, but definitely something to watch. Then we go to, I mean, I thought this was an interesting thing. 4 out of 5 of the major oil shocks cause recessions. Okay, higher oil equals higher inflation plus weaker consumer spending. We have recession odds from Goldman Sachs and Moody's. Not too concerned with that. They're not a great source to rely on. S&P valuation, we're going to get to that. Weak job growth and slower consumer spending, we're going to get to that, but that's definitely another one. But chat's basically saying there is no panic indicators. So let's look at how will this oil shock affect the market. So consumers feel this at the pump. This month, prices for gas have surged about 15 to 20%. Definitely a problem. Where I live, it was $3 a gallon a month ago. Now we're at like $4 a gallon. So definitely is going to impact the consumer. And then it says if oil stays above $100 a barrel, the costs begin to permeate the rest of the supply chain. Shipping for food and other logistics causes the prices of products to go up. Manufacturing industries like chemicals and steel in Europe are already imposing surcharges of up to 30% to offset energy costs. Not good. Because again, that affects everybody in the entire supply chain, the whole economy. Um, if oil remains elevated through the summer, it can cause long-term structural changes. The Fed is currently signaling that higher oil prices will tie their hands, likely pushing out planned interest rate cuts, blah, blah, blah. And current models from the Dallas Fed suggest that the Strait of Hormuz remains closed through the second quarter. Global GDP could remain below, okay, blah, 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 blah. So it's basically saying that if it needs to last a couple months for it really to have a strong effect. Um, and I mean, if you go back here, the last big crash we had in the market was 2022 when oil was around $100. It was actually over $100. And we're pretty close to that price right now. So, again, it definitely depends on how long it lasts, but this could just be the tipping point that pushes us over the edge. And then, this paired with a bad job market or real estate market or whatever it is, interest rates, this paired with something else could be enough to push us over the edge and have a 20-30% market crash. Then we get to stock market valuations. We look at something like the QQQ, which is a popular index fund. Two of the biggest holdings in this fund are Nvidia and Apple. So if we take a look at Nvidia's valuation over these last couple years, Nvidia has come down, right? Nvidia is in a healthy range right now. It's not overvalued by any measure. Apple, if we take a look at Apple, we're looking at, let's say, a PEG ratio of 2.2. That's on the higher side. Forward PE of 28. It's been higher, but it's not cheap by any stretch. It is not cheap. And then you have other ones like Tesla and Palantir that are pretty kind of overvalued, and then you have other ones like Microsoft and Amazon that are undervalued. But the best way to analyze this is looking at charts like this, which is the forward PE for S&P groups, and you can see that the Mag 7 have come down a lot. Mag 7 is in a pretty healthy range right now. You look at large caps, it's kind of in the middle. I mean, you look at these prior to the pandemic years, it was at around a 16 times earnings. Then post the last 6 years, it's been more like a 20. So we're just approaching that 20 mark. So this very well could go back down to like a 16, 17, 18, right? And which you look at 2022, it did crash back down to like a 15. So we could retest those levels again. You just don't know. I mean, you look at this past last year, it also touched down to 18 or so. So it could stall. We could bottom it somewhere in the next couple of weeks here, and we don't see that. The other thing to take into consideration is the blue and green lines for small and mid caps. These are much these are at much cheaper valuations than anywhere we've been in the last 15 years. The blue and green are typically at higher valuations. Now, I also want to revisit here the PEG ratio, S&P. This makes the market look very cheap, which just tells me that all this says is that valuations are a little bit higher than where they typically are historically, but it's also correlated with higher growth rates are expected for these companies, which probably has to do with AI. But the point is, from a PEG ratio standpoint, the market does not look overvalued at all. So all that means is investors are pricing in more growth, and that's why these valuations are a little bit higher for large caps, not for small and mid caps. As you can see here, small and mid caps are still undervalued relative to where they normally trade. It's the large caps, which make it look overvalued. So then we get to the unemployment rate. It's nothing crazy right now. We had the lowest unemployment in April of 2023 at 3.4%. Now we're at about 4.5%. Still not as bad as where we were in 2021. It was over 6%. We probably would have to get closer to that number, around 6%, for it to be a stronger effect on the economy and on a possible crash. So right now, the way I'm playing this is I feel like we're somewhere in the middle. The market has been acting super weird this whole year, the last couple months, the last 3 to 4 months. It's been acting super weird. It has super optimistic days and then super pessimistic days. It goes up, it goes down. As you can see, since Halloween or so, October, it's pretty much been flat because it just goes up and down. I mean, this morning it was the market was at five. The QQQ was at 574, and now it's back up to 590 today. So you just don't know what it's going to do. That's why, again, the way I'm playing this is I'm sitting on a little bit of cash, and because if this goes to $500 a share, I want money to buy into that. And it could even go lower. It could go to 450. So you have to plan for that and just be careful. But at the same time, the bottom could be anywhere around here. The bottom could be 570, 580 or something. So that's why you also want to have a position in this. And that's kind of what I'm doing. So that's the way I'm playing this. Let me know your thoughts down below, and I will see you in the next video.